Adjustable rate mortgages are back in the news, and we're seeing more and more of them. It's been a long time since we've even considered these, with rates having been so low over the past, let's say, 8 years. My name's Miles Pitcher. I'm the owner of Superior Lending. Let's learn a little bit about adjustable rate mortgages. I talked to a realtor the other day. She's fairly new in the business, and she said, I don't even know how these work. So I'm going to cover today for you how adjustable rate mortgages work, why somebody would do them, what are the risks of doing an adjustable rate mortgage, what questions can you ask your loan officer to make sure that they know what they're doing as they talk to you about these. And then I have an example to show you, and this is really cool. This is a client that I quoted last week on doing an ARM, and I want to show you how much money it's going to save them. So here's the kind of the verbiage of adjustable rate mortgages. They're typically over 30 years, and they have a fixed or intro period, and then is variable after that or adjustable. Now, don't freak out that there's a variable rate. In some cases, this is a good thing, and I'll explain more about that in a minute. But as you can see right here, like a 3-1 ARM is going to be fixed for the first 3 years, and then the remainder of the 30 years, it will be adjustable. The 1 just references how often it will adjust after the fixed period. And you can see there's a 3-year, 5-year, 7-year, 10-year option. These are the standard period and options, not to say that this includes all of them, but these are the typical standard ones. Let me walk you through what it means. Like I said, the first number represents the fixed period, 5 years. The /1 is the frequency of the adjustments. SOFR is the index upon which it is based. And that matters once this loan goes variable or adjustable. So SOFR is what has replaced LIBOR. LIBOR got manipulated by some financial institutions. So the primary index we see is SOFR or SOFR. The second most common we see is the CMT, the constant maturity treasury. And SOFR represents secured overnight financing rate. It's a pretty stable index, so we're happy with it. All right. Behind these titles or descriptions, there are caps, and these are generally not shown to you until you're moving through underwriting, but they're definitely something you want to ask your loan officer about. So these numbers are different than that last slide that I showed you, 5-1 ARM. This represents the adjustment caps. So the first 5 says once the fixed period ends and your rate has that first move, what is the maximum it can move? In this case, 5%. So if rates have spiked up, it can move up with that spike with a maximum of 5%. Same thing goes with it moving down. If you do an ARM and then during your fixed period rates drop, right as you leave that initial fixed period, it can't move down more than 5%. After that first adjustment, the middle number comes in and says, what is the incremental or subsequent adjustment caps? Meaning, let's say that your first move, you went from a 5% up to a 7%. It's within the adjustment cap. But then a year later, it starts adjusting again. It's time for an adjustment, and rates have dropped 2%. This subsequent cap is going to keep you from only adjusting down 1%. Okay. The last number here represents the lifetime cap, meaning how much over the life of the loan what's the lifetime cap there. So if your initial intro rate is 5%, that means you're going to have a lifetime cap of 10% in this example. These are important to know. All right, let's visually look at this. The blue line represents our interest rate. You can see how it's nice and level for the first 7 years. And then during the different adjustment periods following, you can see how it is a variable rate. The gray dashed line represents our index of the SOFR. Let's go here. Again, there's our fixed period. Rate stays the same during that period. And then we have a variable period after that where the rate can adjust and move. Then we add in our lifetime cap, and we see that it can't go any higher than that over the lifetime of the loan. This is important right here because how is your rate determined once you enter the variable period? So every ARM or adjustable rate mortgage has an index, 2.75. Some of ours right now are at 3%. So you take the index, wherever that's at, plus the margin, and that equals your rate. At the time of this video, SOFR is at 4.3%. So if you took the 4.3 plus the margin of 3, your rate would adjust to 7.3. Hope that makes sense. And this is important to know in here on index plus margin. The margin does not change through the life of the loan. It's the index that changes. All right, here's some reasons why you should look at an ARM. Is you want a lower initial rate, you want a lower monthly payment. Absolutely. You want to be able to qualify for more home or be able to afford a bigger home. The qualifying for an ARM is a little bit different in that if your 7-10-year ARM, the lender's going to look and say, they'll qualify you using an interest rate of either the greater of the start rate or your current index plus margin. Let's say you're starting with a 10-year ARM at 5%, and currently, like I shared with you before, SOFR's at 4.3. You add the margin of 3%, that's 7.3. So they would do your qualification at 7.3%. That's a little bit higher, but just be aware of that calculation. Another reason to do an ARM is that you may be selling or refinancing during your fixed period. If you believe that interest rates are going to be coming down over the next year or two, you should look at an ARM. Or if you know that your job's only going to have you in a certain location for a few years, 5 years or so, then an ARM definitely should be looked at. The interest rate caps are there to protect you. Just be aware that they can, even if rates are spiking, those caps are going to stop your rate from moving up very rapidly. This also gives you flexibility. Maybe you're just coming out of school and you don't have that high-paying job yet, but down the road, you'll be able to get that high-paying job. Here's some of the risks. Obviously, rising variable rates. So those can, we have no idea where those are going to go, but they do factor into an adjustable rate mortgage. The thing that number 2 here, the thing I caution about my clients about is just understand that you may think that in the future you're going to be able to refinance. Well, what if you lose your job? Or what if your credit gets trashed and you're unable to refinance? Just be aware of that. And number 3, maybe your home value drops and therefore you're unable to do the refinance. So just be aware of that. The interest rate caps can hurt you just as much as they can help you, meaning if rates are falling rapidly, those caps are going to keep your rate from moving down as rapidly as the index is. These are a little more complicated. Many times they're misunderstood. All right, before I share with you this example, here's some questions to ask your loan officer. What are the caps? What index is it based on? If they don't know the answers to that or know what they're talking about, find another loan officer. In the past, pre-2008, we sometimes saw ARMs with prepayment penalties or negative amortization. None of my ARMs that I'm doing right now have prepayment penalties or what we call neg-am loans. A negative amortization is basically where they take part of your monthly payment and add it to your loan balance. and then it reduces how much you have to pay every month, because you're making a small payment and then the other piece of it's getting added on your loan balance. So we don't do those. They may still be out there. I haven't heard of them, but just be aware of that. This is a big one, and this is one I focus on. Is I always show my clients, I say, let's look at your lifetime cap and what your payment would be at that lifetime cap rate, so that you know what the absolute highest payment would be on your home. And as long as you're aware of that and comfortable with that, that's like your worst case scenario, then I'm good having you move forward on an ARM. And then also, if you're counting on refinancing out of an ARM, it's good to know what the costs are, because it is a full-blown refinance and there are closing costs associated with those. We try to help absorb some of those for our clients, but it's a good question to ask. All right, check out this scenario from a client that I helped. $700,000 purchase price, down payment $35,000 or 5%, excellent credit, loan amount of $665,000. This is a purchase. We gave them a great quote at 5.6 on the 30-year fixed. And then I asked him, I said, how long are you going to be in this home? He said, we're going to outgrow this home in 5 to 7 years, and then we will need to buy a new home. I said, great. Let's look at some of our ARMs. We pulled the 5-year, the 7-year, and the 10-year ARM, and you can see the rates right there. Right now, the industry is interesting in that typically you would think a shorter ARM is going to have a better rate than a longer ARM, right? And that's typically how it is. But right now we have what's called an inverted yield curve. So our longer ARMs have better rates than our shorter ARMs do. That's why the 7-year and 10-year are like 4.99 and 5%. Great opportunity to take advantage of those. So look how much it saves in principal and interest. $262 a month, or $258. And then that bottom line I looked at, I said, well, how much does that save you over the fixed period? Let's say you didn't refi, but you stayed in this ARM for the fixed period of the loan. You can see $11,000, $24,000. And then on the 10-year ARM, that means through 10 years, you would save $33,798 payments that you would have made if you had taken the 30-year fixed. Pretty powerful, really cool. We're always happy to run scenarios for clients and helping them to look and see what their options are. So if you'd like us to look at a scenario for you, price this out, regardless of where you are in the country, we're happy to do so. That's how you can reach my team. Feel free to call, text, or email us, and we'd love to answer any other questions you have, or even just show you some options and scenarios. Thanks for watching this video. My name's Miles Pitcher. I own Superior Lending.